Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready to dive headfirst into what is arguably the most complex yet structurally dominant business operating in the United States today.
We are definitely not wading into the shallow end of the pool with this one.
Absolutely not. Today, we're breaking down the undisputed giant of the American healthcare landscape, UnitedHealth Group, or, UNH. And this is not just an insurance company.
Oh, not even close.
This company is so massive, so intricately integrated. It essentially functions as the sector's central nervous system.
Okay.
It's the company you pay into every single month, whether you realize it or not.
It's the elephant in the room for every health policy discussion in Washington and, increasingly for every serious long-term investment portfolio we review.
And here's the key. UNH possesses a truly remarkable, vertically integrated economic structure. It's powered by its service division, Optum, that generates these machine-like, high-quality, consistent profits. But here is the central question we have to answer for you, the investor.
And it's a big one.
Recently, the market has started applying a significant political discount to this stock. So we need to figure out if this regulatory fear, which is stemming from some really aggressive antitrust scrutiny, is just a temporary storm creating a generational buying opportunity in a superb quality compounder.
Or is this the beginning of the end for the model?
Exactly. Are we witnessing the beginning of the Standard Oil trap, where its sheer unavoidable dominance invites and maybe even demands dismantling by the state? That fundamental conflict right there between structural advantage and political liability is what we're dissecting today.
That is the ultimate tension, isn't it? And it's one that requires us to assess, structural durability against raw political will. It demands a level of analysis that goes way beyond just looking at quarterly earnings.
For sure.
But before we get into the details of that vertical fortress, just a quick note for everyone listening.
All right, for those of you who want to act on these deep dive investment ideas, having a professional grade platform that can handle complex trades and, provide sophisticated analysis tools is key. We use Interactive Brokers.
We do?
And we've actually partnered with them to get you an exclusive stock bonus offer when you sign up and fund your account through our link.
So that way, you get a significant incentive to start your investing journey on the right foot, and you support the deep analytical work that makes this channel possible. That exclusive partnership link is, as always, right there in the description below.
That's right. And of course, if you find value in this kind of critical, in-depth discussion, if you want to be well-informed quickly and thoroughly, the best way to let us know, and to make sure you get the next deep dive immediately, is to subscribe and hit that like button.
It really does help.
It truly helps us prioritize the content you want to see. And if you have any pressing questions about UNH or the whole healthcare regulatory environment, please manifest yourself in the comment section.
Perfect. Now that the housekeeping is done, let's get into the structure that creates this unique investment problem. Pillar number 1, the dual-engine business model and the vertical fortress.
Okay, let's unpack the mechanics of this giant. You often hear UNH grouped with, traditional health insurance companies, but that comparison is, well, it's highly misleading, both historically and operationally.
Yeah, you have to start in the 1990s. You have to look at the structural shift in American medicine. As healthcare costs just spun out of control, the old fee-for-service model,
where doctors just got paid for every single test and procedure.
Right.
Incentivizing volume.
Exactly. That began giving way to what we call managed care. And UNH was perfectly positioned to capitalize on this. They evolved into the dual-engine machine we see today.
And that machine is UnitedHealthcare, or UHC, and Optum. They are two distinct, absolutely massive businesses under one corporate roof. But the key, the real magic, is that they're perfectly calibrated to feed each other.
UHC is the classic insurer. It's the risk absorber, the gatekeeper. Its core function is just collecting premiums from employers, from individuals, and most importantly, from these massive government programs like Medicare Advantage and Medicaid.
So their goal is just to assume and price the risk of the patient population.
That's it. And scale is their lifeblood here. The larger the risk pool, the more accurately they can price premiums and the better they can negotiate rates with, say, external hospitals.
And then there's Optum. And Optum, that's the true differentiator, isn't it?
Oh, absolutely. It is the enabler, the service provider, the infrastructure backbone. So while UHC manages the financial risk, Optum manages the actual delivery and administration of the healthcare services.
And crucially, it generates huge fees by providing these services not just to its own insurance arm, UHC, but to rivals and the entire healthcare system. Optum is the technology and service play.
And Optum itself is like a triumvirate of power. It's three interconnected arms all working in unison. So
Yeah.
first, you have Optum Health,
The doctor.
the doctors. It's their rapidly growing care delivery network. We're talking about employing or affiliating with over 90,000 physicians, plus a huge network of clinics, surgical centers, and home-based care facilities. This is where the actual physical care happens.
Then you've got Optum Insight. This is probably the quietest, but I mean maybe the most strategically valuable piece.
I would agree. This is the technological and data brain. It handles consulting, analytics, and it includes that key piece of infrastructure, Change Healthcare, which, as we all learned the hard way earlier this year, is the essential data pipe. It clears billions of claims across the entire U.S. healthcare system.
You don't just use data. They are the data flow for the whole sector.
And finally, Optum Rx, their colossal pharmacy benefit management arm, the PBM.
Right, the PBMs.
PBMs act as this sort of opaque intermediary between the drug manufacturers, the pharmacies, and the insurance plans. They negotiate massive rebates, and they manage formularies, directing patients towards specific, often cheaper, medications.
So when you strip away all the complexity, the simple, brilliant economic loop is this. UNH collects your money through UHC premiums, assuming the risk for your health. Then, UNH systematically pays itself
Pays itself.
via Optum Health for the doctor visit, Optum Insight for the data flow and the coding, and Optum Rx for the prescription. They do all this to manage your treatment and the costs. It's a closed economic circuit just perfectly designed to retain margin internally and maximize efficiency.
And we really have to stress this. This structural endurance is virtually guaranteed for the foreseeable future. I mean, certainly the next 20 years, regardless of minor political swings.
Why is that?
Because the model capitalizes on the two massive structural realities of the U.S. system, the entrenched nature of managed care and the rapid aging of the population, what people often call the silver tsunami.
The managed care structure, I mean, it's so deeply embedded. Neither Republicans nor Democrats have really proposed a successful alternative to containing costs, other than making the system more managed and more data-driven.
Precisely. And the demographics guarantee the demand. As the U.S. population gets older, the need for complex chronic care just skyrockets, especially within Medicare Advantage. And UNH, specifically Optum Health, specializes in that kind of integrated care delivery.
They're focused on cost containment through prevention and managing those chronic conditions.
Exactly. Their services become mission critical as the overall national healthcare spend just intensifies. They're playing directly into the inevitable macro trend.
And this brings us right to the core of their competitive advantage, the economic moat. It's defined by systemic scale via vertical integration. We talk about moats like switching costs or brands, but here, the moat is simply owning the indispensable plumbing, the data, and the people.
They don't just have a large risk pool. They literally own the operating system of U.S. healthcare. By owning the payer, which is UHC, the prescriber, Optum Rx, the data pipe, Optum Insight,
Especially Change Healthcare.
especially Change Healthcare. And increasingly, the doctor, Optum Health, UNH, achieves something unique. They capture margin at every single step of the patient journey. And maybe more importantly, they capture proprietary, high-fidelity information at every step.
Okay, so let's make this tangible with that patient scenario. Imagine a retiree with a UHC Medicare Advantage plan. They go in for a preventative screening, and that visit is with an Optum-employed doctor working in an Optum clinic.
Right. And the doctor's office is using Optum Insight's software platform for scheduling, for their electronic health records, coding, and billing. This integration ensures that the billing codes submitted are legally optimized for maximum revenue. People call it coding density.
Okay. And then the doctor prescribes a maintenance drug.
And that's automatically managed by Optum Rx, who ensures the drug dispensed meets the plan's formulary, maximizing the rebate that the PBM gets to keep.
The outcome here is just economically staggering. UNH, the parent company, internally retains the monthly premium, the doctor's fee, the data fee for processing the claim, the coding fee, and the pharmacy spread.
And critically, because the doctor is employed by Optum Health, that entity is financially incentivized to keep the patient healthy, preventing costly hospitalizations that UHC, the insurer, would have had to pay for.
No money leaves the corporate umbrella.
And this internal cost structure is the source of their durable competitive barrier. Standalone competitors, a regional insurer, a pure-play PBM, or an independent doctor group, they can't possibly compete with this level of margin capture and data efficiency.
It gives UNH the ultimate flexibility. They can maintain superior total enterprise margins while potentially pricing their UHC premiums aggressively low, which effectively starves less scaled rivals right out of the market. They are just fundamentally more efficient.
They are.
So the commercial moat is definitely widening, mostly because of this data flywheel you mentioned. The more patients Optum collects, the more data Optum insight processes.
Right. And better, more granular data feeds better risk prediction models, better coding optimization, and better pricing for UHC.
And better pricing attracts more patients, which generates even more data. It's a self-reinforcing virtuous cycle.
The data flywheel is powerful, no doubt, but we have to circle back to that counterforce. As the vertical moat gets commercially stronger, the political firewall is, at the same time, getting weaker, and that's why we have this political discount.
Right.
However, we can't ignore the structural durability of the infrastructure itself. We need to stress this point. The U.S. healthcare system's sheer dependency on Optum's infrastructure. I mean, the company is clearing over a quarter of all U.S. claims. It makes a complete, sudden, or violent dismantling exceptionally difficult. You couldn't do it without causing a catastrophic crash of the entire domestic healthcare economy.
Let's shift the focus a bit to the intellectual framework for this business.
Yeah.
UNH is often cited as a textbook example of compounding business advantages.
Yeah.
The kind of structure that Warren Buffett and Charlie Munger love to study.
Oh, it perfectly embodies Charlie Munger's Lollapalooza effect. This is that nonlinear advantage you get when multiple independent forces are all operating in the same direction, magnifying the overall competitive effect far beyond the sum of its parts.
Okay, so what are the forces here?
UNH has three major Lollapalooza forces converging powerfully. The first one is the simplest: scale economies. UHC's colossal risk pool means it achieves unmatched efficiency in administrative costs per member per month, and it wields incredible bargaining leverage over the rest of the healthcare supply chain.
The hospitals, the labs, the suppliers who are not owned by Optum.
Exactly. The second is the information advantage. This is Optum's proprietary crown jewel. By owning the data pipe, they have superior real-time visibility into trends, physician quality metrics, and cost drivers that a pure-play insurer or some fragmented provider group just cannot access.
They know where the inefficiencies are, and they know which doctors perform the best, allowing them to route UHC patients accordingly. That proprietary data is a massive, irreplaceable asset.
It really is. And the third, which is maybe the most cynical but also the most powerful force, is the incentive super response tendency.
Okay.
Owning both the insurer, UHC, and the care provider, Optum Health, perfectly aligns the financial incentives toward proactive cost efficiency. UHC wants to avoid paying claims, and Optum Health gets paid a flat fee, it's called capitation, to manage the patient's entire health.
So if Optum Health keeps patients healthy, UHC saves money.
And that saving, that profit, stays entirely within UNH. The financial alignment is just ruthlessly rational.
This synergistic machine is, it's virtually impossible for a fragmented competitor to replicate without spending, 20 years and hundreds of billions of dollars.
Right. But we can't stop there. We have to perform a crucial reality check and look at the business not just from the investor spreadsheet, but from the user's perspective.
Ah, the scuttlebutt view. And how does the customer actually perceive this machine love efficiency? And the answer is, brutally honest, customer love is non-existent, and this is the direct result of that relentless efficiency drive.
Yeah, the sentiment is often described as navigating bureaucratic warfare. Just go look at online forums, review sites, social media. You will find deep, visceral resentment over slow processes, aggressive claim denials, and systems that feel designed to manage metrics rather than prioritize patient comfort.
The host is right then. UNH is a machine designed to be efficient, not empathetic. And that, fundamentally, is the moral and political paradox of UNH.
It is.
I'm struggling with that, though. Doesn't that overwhelming negativity from the consumer base represent a critical weakness that political actors can just easily exploit? Isn't relying on a business model that generates universal customer resentment a fundamental bet on Washington failing to act on popular sentiment? That seems like a very poor long-term qualitative investment thesis.
That is the perfect question to ask, and it is the absolute crux of the bear case. It fuels the political risk 100%. However, the counter-argument is that UNH is a product that is tolerated due to absolute necessity and employer selection.
It's not a consumer-facing discretionary good.
Exactly. The average patient might hate their insurer, but they can't choose a rival who offers comparable scale and, crucially, comparable cost containment to their employer. UNH's indispensability just overrides the consumer resentment until, and this is the key, until the political system decides to step in.
We also need to check the internal reality. What's the employee perspective on this relentless efficiency machine?
The culture is defined by what we call golden handcuffs. Employees, particularly those in Optum's higher value data science, technology, and physician roles, they appreciate the above market pay, the exceptional stability, and the benefits of working for an indispensable giant.
So turnover is manageable, at least in the high-skilled areas.
Right. But the trade-off is massive. You see consistent complaints about high pressure, management that is strictly metric obsessed, especially in the claims processing and call centers, and a massive, sometimes suffocating bureaucracy due to the sheer size and siloed nature of the group.
Efficiency and cost-cutting are prioritized over warmth and, sometimes internal well-being. It sounds like a highly demanding environment.
It is. Now, when we look at the competitive landscape, UNH's structural advantage clarifies itself even further. Who are the direct rivals even trying to catch up to this vertical integration model?
The main ones attempting it are CVS Health, which owns Aetna, and Cigna, which has the Cigna Group. CVS is the most overt copier of the UNH model, right? They've got the insurer, the pharmacy with CVS Retail, and the provider with minute clinics and their recently acquired home care assets.
Right. But they struggle significantly with execution. That massive low-margin CVS retail drugstore drag is just a perennial problem for them, and their vertical integration often feels less cohesive than Optum's.
And that day.
Cigna, on the other hand, is extremely strong in the PBM space with Evernorth, and they have excellent global and commercial footprints, but they crucially lack that massive owned primary care delivery arm that Optum Health provides.
So Cigna can manage the drug spread, but they don't have the same level of granular control over the doctor's office and the specific clinical pathways.
Exactly, and that highlights the durable advantage. No competitor owns a care delivery network and a data asset on Optum's systemic scale. Competitors might own the drugstore where you pick up the pill, but UNH owns the doctor who writes the prescription, the clinic where the procedure is done, and the data pipe that processes the billing.
And that is the key difference, isn't it? It comes down to controlling the expense side of the equation.
100%. Medical costs, the total spending on doctors, hospitals, procedures, is by far the biggest expense item. It consumes over 80% of insurance premiums. By owning the doctors and the data pipes, UNH has superior control over the medical loss ratio, or MLR.
Which allows them to effectively manage, if not outright dictate, the largest expense line item in the entire healthcare financial structure. That capability is unique and durable.
It is.
Okay, now we move from the structure to the operators and capital allocation.
Yeah.
Who is driving this machine, and how has the capital been managed?
The leadership philosophy under CEO Andrew Whitty, who, and this is important, came up through the Optum side of the business, is purely that of a system manager.
Not a charismatic visionary founder.
Not at all. He is a meticulous, results-driven operator. His entire focus is on relentlessly driving integration and maximizing efficiency, primarily through the narrative of value-based care.
Right. That's the core operational concept. UNH aims to receive a flat upfront fee, the capitation we mentioned, to manage a patient's health. And by aggressively keeping that patient out of expensive emergency rooms or hospitals, UNH keeps the resulting savings as profit.
And Whitty is focused on making that transition as profitable as possible. And that focus is intrinsically reinforced by their incentive alignment structure. Management compensation is heavily weighted toward achieving stellar return on equity, ROE, and aggressive operating income growth targets.
This aligns them perfectly with shareholder value. But it is precisely what drives the aggressive operational behavior we talked about. The need to use leverage to boost ROE and the relentless cost-cutting and claims that results in that customer denial friction.
The system optimizes for the spreadsheet above all else.
When we look at the capital allocation track record over the last decade, it is aggressive, but it's also been perfectly rational and strategic. They haven't been chasing trendy, unrelated businesses. They've been building the fortress layer by layer.
Exactly. The mergers and acquisitions, the M&A strategy, has been purely focused on strategic bolt-on acquisitions. Think of the acquisitions of LHC Group and Amedisys for home healthcare, or that massive strategic purchase of Change Healthcare for the data infrastructure.
They aren't just buying generic revenue. They are buying crucial capability to complete the vertical chain and maximize that Lollapalooza synergy.
That's it. And their return strategy for shareholders is equally rational. You've got consistent dividends and systematic share repurchases. However, they are disciplined. They are perfectly willing to pause buybacks strategically to deleverage quickly after a major acquisition.
And the rationality test is passed because management has consistently deployed capital where the returns are highest, right? The services and technology segment, Optum.
Always. Optum consistently generates higher margins and higher growth rates than the low-margin, heavily regulated traditional insurance business, UHC. Optum is the growth engine that keeps the total enterprise ROIC high.
Okay, let's look at the financial architecture, the financial fortress. If you analyze UNH's numbers, they really do resemble a utility company operating within a consistent growth market. It's a machine of stunning predictability.
It truly is. They have delivered consistent double-digit earnings growth for over a decade, and this performance is remarkably counter-cyclical. I mean, people get sick whether the economy is up or down, so the cash flows are robust in any cycle.
And that resilience and predictability are invaluable qualities for a long-term compounder.
Absolutely.
Let's check the key quality ratios, which provide evidence of the business's quality and the management's prudence. First, the return on invested capital, or ROIC.
It's healthy. It's consistently running in the 13 to 14% range. This is a significant spread above their cost of capital, which demonstrates substantial value creation with the funds they deploy. However, a technical note for the sophisticated investor here.
Okay.
We have to acknowledge that this number is actually somewhat dampened by the massive amount of goodwill they carry on their balance sheet.
That goodwill is a crucial detail. Why do they carry so much?
Because when UNH buys a large, high-value asset, like a massive physician group for Optum Health or a unique data platform for Optum Insight, they are buying it for its future earning potential.
And its strategic place in the fortress, not just its current book value.
Exactly. They are paying a premium above the tangible assets, and that premium sits on the balance sheet as goodwill. But even with that large goodwill dampener, the 13–14% ROIC demonstrates that the capital deployed is still generating superb returns.
Okay, second, the free cash flow conversion. This is where the structural advantage truly shines because of the way they handle their cash flow.
Yeah, FCF conversion is extremely high, routinely running over 100% of net income. And this is due to a structural financial phenomenon called the negative working capital cycle.
That's a complex term. Let's break that down for the learner. What exactly is the float and how is it generated?
Think of it like a massive department store that sells gift cards today, but doesn't have to pay its suppliers or redeem those cards until months later. In UNH's case, they collect premiums from employers and the government cash in the door up front on the first of the month. They then only pay out those funds for claims, services, and prescriptions later, often 30, 60, or 90 days later. That cash they hold in the interim, that float, is essentially a low-cost, interest-free loan that they can hold, invest in short-term securities, and use to fuel strategic operations. It is a powerful structural advantage unique to the insurance model.
And finally, the balance sheet. Given their aggressive M&A strategy, they do take on debt, but they manage it prudently.
Yeah, their net debt to EBITDA ratio usually hovers around 1.7 times. For a business with this level of robust, utility-like, predictable cash generation, that is a very responsible level of leverage. It allows them to quickly redeploy capital for the next strategic bolt-on acquisition, and then deleverage rapidly, maintaining financial flexibility without risking solvency.
So we've established that UNH is a high-quality, highly efficient machine with an immense moat and a robust financial profile. So why is the stock not trading at a premium valuation right now, especially given the market's thirst for predictable growth? This takes us to the valuation profile.
And that's the core question. Historically, UNH absolutely commanded a certainty premium. Investors willingly paid 20 to 22 times forward earnings because they knew that predictable double-digit growth was virtually guaranteed, regardless of the economic cycle or global events.
It was viewed as a growth utility hybrid.
It was. But today, that premium has compressed sharply. The stock is trading significantly lower, often in the 15 to 17 times forward earnings range, and this compression represents the political discount.
The market now views UNH less like a growth machine and more like a necessary utility stock with a massive permanent political overhang.
That's it. The machine generates huge cash flows, but it is deeply disliked by regulators and actively targeted by politicians. And this political reality is exactly where the sophisticated investor finds their margin of safety.
Okay, but I still find that conceptually challenging. Doesn't relying on a political discount mean you are fundamentally betting on Washington failing to act? Isn't that a poor investment thesis built on inaction?
Well, it's a bet on the government's inability to act effectively, not necessarily its failure. An investor is protected if the market prices in catastrophic scenarios, like a massive, permanent 10% cut to Medicare Advantage rates or a forced antitrust breakup, that do not fully materialize or, they only materialize partially.
So the current price already assumes significant pain and legislative headwinds.
It does. The floor for the business value, even under intense regulatory pressure, is provided by Optum's sheer operational indispensability to the functional U.S. healthcare system. They simply cannot be easily removed without causing nationwide healthcare chaos.
Let's look forward then. Where does the next phase of growth originate?
The primary growth engine is the ongoing deep structural transition in U.S. healthcare, from fee-for-service to value-based care or capitation. The old model is dead or dying. In the value-based care model, UNH receives that flat upfront fee to manage all of the patient's care for a year, and they keep the savings if they keep the patient out of the hospital.
And Optum is the entire technical and care engine that makes this capitation transition profitable. It provides the vast data analytics, the software, the patient monitoring, and the doctor network necessary to manage large patient populations effectively and, most importantly, profitably.
Which is why management constantly directs capital toward Optum Health. Now, let's confront the permanent impairment risks, the bear case that truly worries institutional investors. There are two major threats that could permanently destroy the core investment thesis of consistent double-digit growth.
The first and the most terrifying to shareholders is an antitrust breakup. The Department of Justice forces a complete separation of UHC, the insurer, and Optum, the service provider.
This would instantly destroy the core Lollapalooza synergy. If Optum has to compete for UHC's business, and if UHC is legally mandated to pay fair market value to Optum Health, the internal data advantage and the perfect incentive alignment just vanish.
You're left with two separate, very good but distinctly average businesses, not one unparalleled fortress.
Exactly. The entire rationale for the valuation premium is tied to the synergy of that vertical stack.
The second major threat is the Medicare rate cratering. And we've already seen regulatory scrutiny translating into aggressive, permanent cuts to Medicare Advantage rates. That was highly evident in the 2024 and 2025 rate decisions from CMS.
And Medicare Advantage is UNH's most profitable insurance business line because of the efficiencies they can layer on top. If the government permanently shrinks the profitability of that entire segment, the financial machine slows down.
And if cuts are aggressive enough, the historical investment thesis for consistent double-digit earnings growth is severely damaged, leading to a permanent re-rating of the stock multiple.
Oh, sure.
Okay, on the flip side, what are the potential catalysts that could lift this political discount and unlock significant shareholder value in the near to medium term?
The most immediate and powerful one would be a regulatory settlement, a clear, definitive resolution, a fine and move on agreement with the Department of Justice regarding the vertical integration model. That would signal that the legal system accepts the status quo, even if regulators don't love it.
And that would remove the immediate political overhang and lead to an instant multiple re-rating.
Instantly. Uncertainty is the multiple killer here.
And the second catalyst is entirely technological and sits right in the data engine, Optum Insight. It's the aggressive AI implementation in core administrative functions.
This is a huge potential driver. I mean, think about it. Automated prior authorizations, claims processing, complex clinical documentation, billing management. These are incredibly expensive, manual, and friction-filled processes today.
So if AI can radically automate and reduce selling, general, and administrative expenses by even a fraction,
UNH could boost margins significantly, even if the top-line revenue growth decelerates slightly due to the regulatory environment. And they're better positioned to utilize AI than anyone else because they own the data and the pipes that flow through Optum Insight.
Okay, so let's synthesize the bull case. What is the elevator pitch for owning UnitedHealth Group today based on our deep dive into the business structure?
The core thesis is that UNH is the healthcare utility. It is an inescapable tax on the growth of the entire U.S. healthcare sector. You are investing in the technologically superior, indispensable backbone of the system.
The vertical Lollapalooza creates an unmatched, synergistic efficiency engine, combining data, risk, and care delivery. And the cash flows are robust, predictable, and counter-cyclical, providing exceptional resilience regardless of the broader economy.
And, most critically, the intense 2025 regulatory fear has created a rare and potentially temporary discount on a superb quality asset. If you believe the core structure holds against the political headwinds, this price is a unique generational opportunity.
But the market consensus is bearish right now. They view UNH as a political target, and they view Medicare Advantage as a deteriorating business because of those rate cuts. We need to perform some robust second-level thinking here.
That's the necessary step. And the contrarian insight is this. The rate cuts from CMS don't hurt everyone equally. They are a structural disadvantage that disproportionately harms smaller, less scaled competitors who don't have the vast Optum efficiency engine to fall back on.
So UNH has the structural scale to absorb the margin pressure much better than, say, a regional or a state-specific Medicare Advantage plan. They can survive the squeeze.
And consolidate market share as those small plans exit the market or are forced to merge, and they can ultimately emerge from this period with even greater pricing power due to reduced competition.
So the regulatory noise is a temporary storm, which suppresses the multiple today, but the structural climate of intensifying demand for managed care and cost containment remains firmly in UNH's favor.
Exactly. The storm creates an opening for the largest player to absorb its rivals.
Okay, now for the final, most critical component, the red team challenge. We have to invert the thesis and argue against the very dominance we just admired. This is the Standard Oil trap.
And this is where politics meets profit in the most dangerous way. The very integrated dominance that investors admire, that ability to capture margin at every step, is viewed by the DOJ and key politicians not as efficiency, but as an illegal tying arrangement.
And the fundamental cause of healthcare inflation in the U.S.
That's the narrative. The legal and political danger is immense. If the courts agree with this framing, that the vertical integration constitutes an illegal tying of the insurance product, UHC, to the necessary service provider, Optum UNH doesn't just face a fine. It faces forced structural dismantling.
So you are potentially buying a complex, highly tuned conglomerate right before it enters a likely decade of expensive, distracting litigation hell over its very right to exist in its current form.
That's the risk. Furthermore, we must not forget the lessons of the Change Healthcare cyber attack earlier this year. That catastrophic event demonstrated that UNH, specifically through Optum Insight, is a systemically dangerous institution, or an SDI.
Let's define SDI clearly. What does that label mean, and why is it so dangerous?
A systemically dangerous institution is a company whose sudden failure or operational disruption causes widespread, catastrophic, non-recoverable damage across the entire economy. When Change Healthcare, the heart of Optum Insight, went down from that cyber attack, billions of dollars of claims just stopped flowing.
Providers couldn't get paid, hospitals couldn't bill, pharmacies struggled to verify prescriptions. It was a failure that demonstrated the critical nature of the UNH infrastructure to the point of national security.
Exactly. And what does being labeled an SDI invite? Heavy government oversight, mandated audits, and regulations designed to prevent future systemic failures, much like the post-2008 bank regulations.
And that level of compliance and oversight will inevitably suffocate the aggressive, high return on invested capital that management has historically achieved. Regulation is inherently inefficient.
In the red team view, the very structural moat that made UNH indispensable to investors has now become its prism, trapping it under the intense scrutiny of the U.S. government, which is now actively considering whether the company is simply too big, too powerful, and too integrated to be allowed to continue operating in its current, highly profitable form.
And that brings us to the core tension of UnitedHealth Group. It is a financial machine built on one of the most robust competitive structures in modern history, designed for relentless efficiency and unparalleled returns. But this very structure, this vertical fortress, has made it the single largest political and regulatory target in the entire country.
The investment decision hinges entirely on whether you believe the government, which is desperately fighting rising healthcare costs, will ultimately see UNH as indispensable and tolerable because of its scale and efficiency, or fundamentally anti-competitive and worthy of dismantling.
It is a risk calculation, unlike almost any other in the market today, balancing undeniable quality with unavoidable political risk.
And that takes us to our final provocative thought for you, the learner. The discussion about UNH forces us to confront a fundamental question relevant to all market giants, from Amazon to Google to UnitedHealth. In the 21st century, when does scale stop becoming an unassailable competitive advantage and start becoming an existential political liability?
Consider how the perception of efficiency and cost containment can flip to monopoly and price gouging overnight in the public square, and whether that specific political risk can truly ever be accurately priced into a stock's multiple, or if it remains a permanent, unquantifiable drag. That's the knowledge you leave this deep dive with.
That's it for this week's Deep Dive. Thank you for joining us, and we encourage you to continue your own due diligence and critical thinking.
We'll see you next time.